here and go from there. So yeah, so again, my name is Josh Schuler. I've been a trader for about 9 years now. I've been exclusively in the future space for 4 years. I've been a full-time trader for 4 years, as well as doing other things, which I'll talk about that too. Just if you want to look at doing trading as a business and eventually being your profession and your income, there's lots of ways to do that. And especially if you're starting out and you don't have a lot of capital, like how do you grow capital so that it can be your full-time deal? And what does that look like? I think futures are a key component in that, because it provides an opportunity for people who are not highly capitalized to be able to play in the space, and we'll talk about that. But it's a way that has allowed me to do other things that I can keep income going and then simply trade and build that account up so that then that could become either an additional viable income stream or my total income stream, and all of that. So, all right, well, let's dive in and talk about what futures are, and then how I trade them. We'll even look at some examples from today. So, first of all, futures are they are a contract. So if you've traded options like stock options, they're actually options on futures, but a future is a contract for a delivery of some underlying product sometime in the future. So whether that is crude oil, which is there's crude oil futures, or whether it's gold, or whether it's index or equity futures or currency futures or treasury bond, it's allowing someone in the future to do that. And here's how they came about. They came about as a means of insurance for those who deliver a physical commodity. So imagine, for example, that you raise live cattle, and you have cattle and there's a cash price on the cattle that you're raising. And at some point in the future, you want to deliver those cattle. And so the futures market was developed as a means for those who produce those products to deliver that at some point in the future at a fixed price. So for example, if say my cattle price is 125, if the futures was at 135, I could sell a futures contract against my cattle at 135 and basically lock in $10 of profit today. And then at the point that I deliver them, that's basically guaranteeing I'll deliver them at that future date, and I'll be at that price, and I've locked it in. So it's a great way for those who deliver a underlying product or commodity to have insurance against that product. I know guys, I have friends that are in oil or fuel supply business, and they use futures all the time as a hedge against the physical fuel, whether it's gasoline or oil that they own, to make sure their margins are good. So it's a very practical business tool that real world businesses use to help ensure that they can stay profitable. Now as the futures market started, and they've been around for about 100 years, a little bit longer than that, have been active. You can do that and be a hedger, so you can hedge a physical commodity where you're actually owning the physical commodity, and then you hedge the contract against that. Or you can do what's called speculation. And speculation is where you don't own the underlying commodity, but you actually are buying the contract, and then you can buy it at one price and sell it at another price. But you're never going to go to delivery because you don't have anything to deliver. Now, that plays a very important role in the whole dynamic of markets, because what that does is you are, as a speculative trader, which those of us who trade futures, most of us are speculative traders. We're speculating that, hey, it's at this price today, and maybe later today it's going to be at this price, or tomorrow it's going to be at another price. And we are adding to that market a degree of liquidity to those who are trying to hedge their physical commodity. So we're a little bit like a middleman who can assume the risk of the person who owns the commodity, and we can then sell it to someone else, and we can be in between people who are operating at all kinds of different time frames. And what this does is this provides actually incredible opportunity, not just for us as speculative traders, but also for those who own the underlying commodity, because as a market fluctuates, they can capture additional revenue and gain as they're hedging their product. So, one specific approach to it is like, say you own live cattle and you go and your cost base is at $1.25, you sell it at $1.35, you've captured $10. Well, let's say that then the cattle market goes down, the futures cattle market goes down, and then you take that hedge back off. So you basically, if you sold that contract, you buy it back, and then maybe that contract goes back up to 135, and then you sell it again, and your basis is still 125. So now you've got $20 of margin in your product. So that it can be a really great way to increase the basis that you have in your business. And you think about it, any business, they're always looking at profit margins. And so futures are a way to do that. And we as speculative traders introduce liquidity into these markets that allow these products to work. And these are the real, when I say professional products, these are the real products of the world. Futures allow you to trade currencies and indices and metals and grains and bonds. I mean, it's all the stuff that makes the world go round. We'll dig into those a little bit in a bit. But they're also 23/6. So these markets trade 6 days a week, 23 hours a day. So for those who like to trade Forex, I mean, you get a little bit of the Forex experience. And for those who trade equities, like stocks and options, which are locked into the real-time session of the US markets, this actually allows you, futures allow you to take advantage of the equity flow as it goes around the world. So you have the US session, when that closes, then liquidity moves around the world to Asia, and that moves, and then it comes back around to Europe, and then it comes back to the US session. So we are able to take advantage of that through a 23-hour session. So say, for example, you've got a full-time job during the day and you want to be able to trade something when you're not doing your full-time job, you can trade futures because they trade 23/6. For example, last night, Germany came out, they released negative interest rate bonds, and those sold and market spiked. There's actually some great volatility last night in futures markets, which you could have captured because you can trade them 23/6. Whereas if you're just trading the real-time US session from 9:30 to 4 Eastern, then you really missed a lot of that because the actual real-time session didn't move a whole lot, but the overnight session was really wide. So that's pretty cool. The simplicity is another really great thing about futures. I mean, it's almost also so for those of you who trade Forex, because you're looking at a set number of Forex pairs. But if you're a lot of guys that look at stocks and options, they're looking and running scanners on hundreds and hundreds of stocks, companies they've never heard of. They don't know if that company's going to be around tomorrow. And for me personally, I was looking for a way to participate in markets that was just simple, that I could look at the same products over and over again, and I could discern, do I want to play or do I not? And go with it. I don't have to do massive research on a company. Don't get wrapped up in the emotion of a story around the company. I can just look at this market and decide, how do I want to express a position or express a bias. So it's a very simple product. It's also simple in the fact of how it's executed. You simply buy or sell. So for these contracts, you either buy the contract or they sell the contract. Now you can open a position by either buying or selling. So these are contracts and products that allow you to trade both long and short in a market. So you don't have to always have a long bias posture, and you don't always have to have a short. You can trade these both ways. So it allows you to be very nimble in markets, which is really great. So you don't have to think about, well, I'm going to just be on the sidelines if it's a bear market, and I'm just going to be on the sidelines. You can play in all of that. You can capture all that. It's an incredible product. And then finally is the idea of leverage. And that is that this is a product that allows you to play with a much smaller amount of capital and see an expressed gain. And I'll show you an example here in just a second. But let's look at some of these products and what they are and some of the things that you can trade. So you can trade equities. So the NQ, the ES, the YM, and the TF, these are the symbols that are used for these products. So the NQ is the NASDAQ, the ES is the S&P 500, the YM is the Dow, and the TF is the Russell 2000. So these are the four major indexes. You can actually express a opinion about the direction of these indexes by trading these contracts. Currencies, you can trade euro, you can trade the dollar, you can trade the yen, you can trade Aussie dollar, you can trade Canadian, I mean, you can trade a number of currencies. That's so 6E is the euro, DX is dollar, 6J is the yen, 6A is Aussie dollar, and there are others. But there are ways you can trade. I mean, you can trade the British pound. You can you can trade currencies. So if you like Forex, you can trade Forex and express an opinion on currencies by using futures products. Metals, you can trade gold, you can trade silver. Energies, you can trade crude oil, you can trade natural gas. Agricultural products, there's soybeans, which is ZS, corn, which is ZC, LE, which is live cattle. You can even trade volatility. So if you're familiar with the VIX and know what that instrument is, you can trade VIX futures and express an opinion on the VIX in some of these contracts. Now, what's great, this is the really cool thing about this, and I've tried to help people wrap their head around futures and what the opportunity is from that in terms of what you need to be able to play and how this could play out, is this idea of leverage. So let's look at this as an example. So let's say you're going to trade the triple Qs. Now the triple Qs are an ETF, an exchange traded fund, that allows you to express an opinion on the direction of the NASDAQ 100 index. So that's 100 companies that make up the NASDAQ 100, and the triple Qs is an exchange traded fund, means it's a product they've distributed money into, invested in all 100 of the NASDAQ companies, and they've spread that out based on the cap ratio. So whatever the market cap in terms of the size of the company, that's how they've weighted all of this in the triple Qs. And you can buy the triple Q. I think today it was like $111 a share, and you could buy triple Qs and express an opinion on the triple Qs. And let's think, what's the opportunity? So the average trading range right now on the triple Qs is $1.41 a day. Okay, so if say you wanted to make $200 a day, you would need $220,000, and you'd need to capture 70% of that move. So think about that. Say you wanted to make $200 a day, which, by the way, $200 a day is $60K a year. If you did that every day that there's a trading session, $200 a day, you'd need $220,000, and you'd have to capture 70% of the average trading range of that product. Now, the NQ contract is a futures contract that is married to the exact same instrument as the triple Qs. The NQ contract is actually a contract of a position toward the NDX 100 or the triple Qs. However, its average trading range is 60 points a day. So that 60 points equates to $1.41 in the triple Qs. But if you wanted to make $200, you actually need $3,960 to purchase the contract to capture 10 points or 16% of the average trading range. So if you look at the opportunity between the products, it seems pretty clear what you would do. You don't have to have as much capital, and you also don't have to be as right. So, I mean, think about that. Trying to capture 70% of the average trading range every day, you got to be pretty damn great. And you have to have read the same day, know it day in and day out. However, if you come in and all you got to capture is 16% of the move, there's a much higher probability of success. And that's what's available when you trade the futures contract. And that's why the leverage is really, really powerful. Some other benefits around futures that you don't get elsewhere. One, at the end of the year, taxes are so simple. You don't have to enter every trade that you do, like if you do stocks. You simply get a 1099 with just a line item of what's the net growth, and you can plug that into your taxes. It's so simple. It's just awesome. No theta decay. So if for those of you who aren't familiar with options, like equity options, so the equity options are coupons for the purchase of a stock at some point in the future. And that the value of that option, it fluctuates. And it's based on what the market expects the price will be at some point in the future. Well, the closer you get to the future, wherever that date is that option expires, if it turns out that the price that coupon was good for isn't as likely, the value of that contract will actually contract. So you have something called theta decay or time decay. So as you get closer to the expiration date of when that contract goes up, then you could actually lose the value of the contract. So say, for example, you bought an option and you're expressing an opinion, and you were actually, you bought an option and say a week later, the underlying got to the price that you were actually targeting, and that's where you wanted to profit. But because it was a week later, you could actually have lost money even though the underlying instrument got to the price that you wanted. This is what's theta decay. In futures, there is a fixed value for every move of the contract. So say I sell, like right now, I shorted some NASDAQ futures today, right around 85 area. If we go up to 4,700 and then we come back to 45.85 a month from now, I have lost nothing. Whereas if that kind of scenario had happened in an equity option and we got back a month from now, I probably would have lost everything because of the theta decay. The contract would have been worthless. And then finally, this idea of simple expiration or roll cycle. So say, for example, I was short a position or long a position, and I want to hold this thing. It is a contract, so it doesn't have an expiration. It's not like a stock that just, unless the company goes bankrupt, it's always there. You do have these expiration cycles, and the different products have different expiration cycles, and those come up in different ways. For the equity futures contracts, those expire once a quarter. So right now we're trading a contract that will expire in September. Well, guess what? If I'm in like a longer position and I don't get to the target by the time we get to September, I can actually just buy back that contract, resell the December contract, and I'm right back in the position. It's so simple, and I've really lost virtually nothing in the roll from that. So it's a very simple way to express in these products. So that's just kind of a high overview for futures. If there's any questions that you have, feel free to throw them in the question box, and I'll throw those in there. Next, I want to talk about kind of how do I identify opportunities in looking at futures, and then we'll kind of look at today and what was going on there. So with that, I use a tool called market profile or volume profile. So this is nothing more than just a way of arranging the data in any trading session so that I can see an auction in real time. So, lots of guys use stuff like moving averages and Bollinger Bands and trend lines and RSIs and ADX and all of these different tools that people mark up their charts and they end up looking like spaghetti. But what many traders fail to realize about all of those indicators is that they're lagging indicators, meaning that whatever the value is of that indicator, it's generated based on something that's already happened, not on what's going to happen. And if you think or know anything about business, or you're kind of entrepreneurial focused, you know that the greatest opportunity does not exist after identify a trend. The greatest opportunity exists when I can see the opportunity before it happens. Right? These are the entrepreneurs that make great money and the startups that do incredible stuff. It's because they saw a need in the market, they saw an opportunity, but before it happened, and then they jump on that opportunity and they ride that. They get the biggest move out of it because they get on it before it happens. Well, this is what market profile allows you to do. It's not a replacement of a trading system, so you can use all those other things, but this adds context around the market, and it allows me to see a market as an auction. So that, and I don't know why it took me so long to think about this as a trader. I mean, it took me 4 years as a trader before it dawned on me that what I was looking at on these squiggly lines on these charts every day, I was looking at a graphical representation of an auction. So, when you think of it as an auction, like many of us have been around auctions. We know what auctions are. We've experienced them, whether it is we went to an estate auction or we went to an art auction, or how about a housing market? Like that's a type of auction. And there's behaviors that are predictable and consistent that occur over and over again in auctions. And it's like behaviors that are millennia old. I mean, this is human behavior for almost as long as there's been civilization in terms of what people look at. And think about one of the key concepts around an auction is this whole idea of what is value. So if I'm participating in an auction, say for example, in the, an example of the housing market as an auction example. So if I go buy a house, do I just want to pay anything for the house? No. I mean, I want to know what's, people always go, what's the comps? What's the comparables in the neighborhood that I'm looking at to buy it? Why? Why do I look at the comps? Because I'm trying to get a assumption, or not assumption, I'm trying to get my arms around and trying to ascertain what is the value of this neighborhood? What's the average price that I could expect is reasonable for me to spend in this investment? And if I can, I actually want to try to secure it under value, right? I want to sell above value and I want to buy below value. But I got to know what the value is. And what market profile allows you to do, or its equivalent, volume profiling, it allows you to do that looking at a market. And this is a tool that did derive and originate in the future space. It's based on the research of a guy named Peter Stottlemyre, who was at CBOT in the 80s. And he was noticing this auction behavior that was taking place in the markets. And he's like, how can I graphically represent, how can I see, because if I could graphically see it, then I could go, oh yeah, here's where we're below value and here's where we're above value. And then that would give a trader incredible information on the bleeding right edge of where the trade is actually happening to discern where should I enter and where should I exit. Where am I right and where am I wrong? Where is an opportunity and where isn't there an opportunity? So this is a tool that I use, and we use it primarily built around this big concept, is that it shows how much time a market spends at a given price and gives a visual as how value is built. So it's based on time, price over time plus volume equals value. So not just, is it not just do we hit a price, but how long did we spend at that price? So say, let's go back to this housing market example. So my wife owns a business. She stages for realtors in our hometown, and she was working on a project that all the comps in the neighborhood were selling for like $350, and the house that she was staged, someone came in and bought the house for $725. So almost double, almost double what the comps were in that neighborhood. So if you see something happen like that, you stand up and you go, okay, what's going on? Like, is that a significant thing? Did the market just change, or was that just a one-off? So you don't know. But what you need next is you need to see what happens in the next auction or the next house that sells in that neighborhood. If the next house in the neighborhood sells closer to that 725 number, then you could say, oh, maybe value is shifting. However, if the next house goes back and sells at 350 or 325, then you know, hey, that was just a one-off and that was somewhat a little insignificant. We actually had something happen like that last night in the equity futures, where we had, for example, the NASDAQ futures shot up to 4606, I think, was the overnight price, which is a high price relative to the prior day, but we never spent much time there. We went up there, turned around, and we spent time much lower all day long. We never went back up to that 46. So for the moment, at least, it appears that that was just a one-off. It was insignificant, and it's not a price that I really need to think about. Okay, that's what profiling looks like, and it's graphically representing that. So here's a way. This is a very rudimentary market profile, but it arranges each trading session, primarily the real-time New York session, in 30-minute increments, and it assigns each 30-minute increment with a letter or a number, and then as the next 30-minute increment comes out, it gives that a new number, and it'll print that letter for all of the prices that are touched in that session. So say, for example, if we look at this profile right here, that we've got on this third profile, there's like, H session, so it trades from all the way up here, all the way down here, and then I session, trades, for a little bit, and then J, and eventually they just kind of build over. What you start to see happening, you start to see this bell curve, and it really is a statistical fight for what is value. And this pink box is what we call the value area. That's where 70% of the trade, or if you know your statistics, it's the normal distribution of trade that takes place each day. And then there's actually a place inside this value area that's what we call a point of control, or the fairest price. And that's the price that was traded the most on that day. And so that is the price that was the most agreed upon. That's the most relevant price. And you can use these prices and carry them forward for subsequent trading sessions and lean on them. And so you're not just leaning against some moving average or some trend line. You're actually leaning against what has the auction actually done. And this is extremely powerful because it does. What it does is it allows you to see the opportunity before it's gone. You know, by the time the trend's developed, it's too late. This is allowing you to see it before. It also allows you to do a very important thing is that as you're able to think about the market as a live auction, you can start to see who are the participants. You know, is this big money? Is this small money? Is this a significant move? Is it not? Is it, you know, where's the auction trying to go, and how good of a job are they trying to do that? And then you can pick out, well, man, what am I willing to risk to participate? And this is all stuff that's available inside of the auction. So now let's look at some examples. So I'm going to pull up here. This is a product that I use to look at the markets. It's called Window Trader. Fantastic product that allows me, and it probably doesn't look like much like what many of you have seen before, but let me walk you through just some of the elements. So this actually was today's trade in the NASDAQ. So couple key elements. So this bar over here on the left, this is like the candlestick that you would see on a daily chart. And then this histogram here shows me volume in a histogram that's taken place as the day has gone on. And then this column here actually tells me how many contracts were traded at every single value point, or what we call tick, because that's another thing is that these contracts move in what's called tick values. And that is a little bit of a nuance to learn is, you know, how many ticks does each contract have, because some of them are different. The NASDAQ moves in 4 ticks equals 1 point. So, you know, to go from like, for example, 45.92 to 43, you actually go 45.92, 49.92.25, 45.92.50, 75, and then 45.93. And each one of those ticks is worth $5 on the NASDAQ. So if you get a full point, that's $20. You get 10 points, that's $200. If you get 50 points, that's $1,000 with one contract. Okay, so pretty cool. So let's look at what the range was for today. So I can see that today the range is really from 45.99 down to 45.78. In fact, this tool is really cool because it actually shows me exactly the current range, which was 83 ticks. The average is 173 ticks, and this is over the last 20 days. So we actually were below the average range, and I also get to see statistics of how many contracts took place at every half-hour session, and were those below the average of the last 20 days or above average. So if you think, you know, again, think about an auction, why is this relevant? I mean, if an auction is moving in a direction, I want to see people buying or selling and with conviction. If I see them waning, if we're moving in a direction and I see them pulling back in their participation, I'm starting to get suspect of that move. And so I'm starting to think maybe this thing is exhausting, this auction is exhausting, and it's got to go the other way to bring somebody in. Imagine a housing market. Prices are moving up, they're moving up and up and up, and then all of a sudden they stall. Well, why do they stall? It's because nobody is willing, no willing buyers are left to participate at that level. So then what happens is price starts to fall to try to find buyers. And it'll fall as deep as it needs to go until it can find enough buyers to slow the fall and then bring it back up. And it's just this constant ebb and flow. And one of the ways that we can see that is in the participation and the number of contracts. So other things that this tool allows me to see is I can see, here's these 30-minute sessions. So, I'm on Mountain Standard Time. So we start at 7:30. So that the A session here was all of the prices that were touched. So we basically went from 45.90.75 all the way down here to 45.79 in the first half hour. And then B was the next. And then in fact, this green line here actually shows me what we call the initial balance, or the range of the first hour. And that's always important in terms of identifying how I identify what the opportunity is on the day. So how we either move past that first hour or stay within inside it, or even how wide that first hour is, gives me an idea for what the opportunity is like in that day, and then also relative to the prior day. So today, I was looking, and this actually breaks out each 30-minute session and shows me the contracts that traded on each 30-minute session as the day went. And the colors here, the red says that this was the highest 30% of contracts in that session. This is the next tier of contracts, and then these are the bottom tiers, the white. So it's allowing me to very quickly visually see where people are participating in this auction, where are they not. And I'm allowed to get in. So basically why I'm currently short at 85. So I got short at 85 because we were never able to go get that 46.08 overnight. And when you're unable to get the overnight high in the first hour of trade, one of the things that happens is that liquidation. It's basically saying that the market needs to go lower to find buyers. And then the other thing that's over here on the right is this is the composite auction for a set period. So in this case, this composite auction is about 13 days old. I could go in later to what that is, but this will give me a level that I can lean against. And you'll notice there are peaks and there are valleys. So there's predictable behaviors around peaks and valleys. So think of a peak as, here were comps. Here were places where people did lots of business, and then valleys are places where people didn't really do a lot of business. So the bigger the peak, the more significant that area is. So you can see if I scroll out here, there's a bigger peak here and a way bigger peak down here. And then the more the lower the valley, that means less people did business there. So right now we closed underneath this peak. So that is, my assumption is I'm looking at that as a kind of a ceiling. Okay. Now, if we trade back above that tomorrow, then I'm wrong. But as long as we stay below this, then my assumption is that we're likely to go and test this peak, actually more likely to go test this peak down here at 75. So if I'm short at 85 and I take it down to 75, for each contract I have, that's 10 points, that's $200 a contract. So if I have 10 contracts, then that's $2,000. Okay, right now I got 20. So if we move that 10 points, I made $4,000. That's how it works. So that is a view in futures. So I'm short there. We'll look at another future. This is crude oil. Okay, same instrument that I'm looking at to help me identify levels. And I'm actually long crude oil. I'd really like to see it above this area. So again, these peaks, these are areas where we've done trade before, and what happens around those areas is that the market tends to slow because there's been agreement around that. When we get past that and we get into lower areas, then we start to see some speed up. So if you've ever been in front of a chart and you're like, man, why the heck did that thing move so fast? Or why did we kind of slow in this area? You're actually perceiving the auction slowing or moving across places it's done business or not. This allows you to graphically see that. So imagine you can actually start picking spots. So like if I'm long crude right here, basically if we can't get above this, then I'm wrong and I need to exit this trade because we're likely to go down until we can find the level that we can build out. But if we get above that, then this becomes a great floor that we can move higher. So that's just kind of a view of futures and what those products are, and then how I use this tool market profile to discern that. That's about all I got. So if anybody has any questions, they want me to look at specifically, happy to do that. Otherwise, I'll wrap this up and we'll be done for today. Yeah, I love this. While I'm waiting for, and I'll give us about 5 minutes if anybody wants to type a question. But one of the things I love about this tool is this allows me to see. I used to have like 4 different charts of the same product all running at the same time, so I could see like the daily chart plus the intraday chart plus all the stuff. And what's so cool about this tool is I can see all of that in one window. So how it allows me to just really quickly discern where the opportunity is and to place trades is fantastic. Super cool, and you can see why in a specific session or like candle session. So these are the 30-minute candles. This is a daily candle. These are 30-minute candles, and this is the contracts traded at. So for example, this right here equates with this candle. So if you notice the darker band here, it almost matches where the open and the close was on this candle, because that's where most of the business was done. The rest was excess. Where we have these wicks on the candle, look at the volume of contracts. There's actually much smaller volume of contracts that take place where those wicks are. So I can actually watch this thing go through the day, and if I watch as we get away from it, I can watch this thing move and get less and less and start to exhaust in terms of the number of contracts. I can look at that as a turn, and if I wanted to, I could just trade this back and forth all day long, just watching exhaustion taking place in these sessions. It's pretty fantastic. Pretty fantastic. All right, well, I'm going to go look at some other products and just kind of see where they are. These are the kind of 12 products that I look at every day. You can see, and these are just standard candle charts. I use this just kind of as a first way to just identify what's moving, what's not, what's kind of range bound, and then I can go to the profile and dig in a little bit deeper. But the top 4 are the big indices, so NASDAQ, S&P, Dow, Russell, and then this is the VIX. So this is volatility futures, gold, the dollar, 30-year treasury bonds. This row right here is all ag products, because I do research analysis for agricultural hedging firms, and these are the products that we look at in that space. And then I've got a couple more currencies, the euro, the yen, natural gas, and crude. So I look at these 12 products. I look at these 12 products every day, and it gives me incredible opportunity to keep my frame of focus simple and go about the other stuff that I'm doing, so that I can continue to grow this thing. And that goes back to the point of how do you make trading your business, or how do you make that your profession? You could be a successful trader, but the way that you really make money in this thing is if you can grow the account that you have, then you can put more on the trade and you can make more. Where if you're putting the same amount every time and then you're skimming off of that, you never really are able to grow your business. So for me, I've been able to grow my accounts by having a simple product that allowed me to interface with markets, take money out of markets consistently, and build my account while I was doing other businesses that was basically paying my paycheck. So that allows you to really grow the account, so the point where I can not only take what I need for income, but I can also continue to grow the account. So I can keep giving myself a raise, going through that. So that by having just a simple thing to look at, that keeps my frame of focus really simple. Okay, we've got questions. Question was, do I use TOS volume profile, and if so, could you give an explanation or example? So I have used TOS volume profile. In fact, I'll show you. If this allow me. So this is a TOS volume profile that shows me each real-time day session with the volume profile of the real-time session. These yellow lines are the value area. That's 70% area value. The red line is the point of control on that day, And then I've got over here, I've got the composite profile that shows up for the 20-day. Now, here's the thing about TOS and the idea around market theory that doesn't sync up, and this is why I use Window Trader as an augment, is that say we have essentially 1, 2, 3, 4 days where we've been seeing the same price, and then if we go back 1, 2, 3, 4, 5 days back here, these are all kind of the same price. So you can think of these as a balancing area, and what I would love to be able to do is to go look at these 5 days as a composite and just focus on those. And I can see that over here in TOS, but it actually, if there's days in front of that, so if I go, I mean actually I could include these back here, but if I just wanted to look at just these 4 days from here to here, I have to infer that in the composite profile. Whereas in Window Trader, I can go back and look at, say I want to take these 3 days and say they were in balance. I can just drag across 3 days. And then it creates a composite profile of just those 3 days, which is crazy powerful. I mean, right now it actually would say, hey, look, unless we can get below 68, this market's not going down, because that's the composite point of control for those 3 days. Where I can't do that in TOS. So here's what you have to kind of end up doing in TOS is you have to look across multiple time frames and try to discern it. So I've used like a 9-month composite profile, and then the actual profiles on a week, and then looked at the 20-day, and then the last thing that I'll do is I'll look at, so this is like a trigger chart where I can actually like place trades off of, but this is like a 5-day. So one way that you can use this if you don't have like Window Trader is you can say, okay, where are the points of control across all the time frames? So if this is the if I'm looking at NASDAQ, 5-day composite is at 45.70, 20-day is at 44.01. So in terms of a bias, we're bullish on both of those time frames, and it actually would, if we were going to get bearish, we'd have to get below 45.70, and it always happens on the nearest time frame first, and then you start looking at the other time frame. I mean, this actually happened in corn, where we are above. We were actually below, but now we're above both the 5-day and the 20-day, and so you can blend between those. But yeah, that's a great question. I did look at that in TOS. You can use it in TOS. The drawback is that you can't set the time frame that these composite profiles build. And auction theory, which is what we use when we look at the auctions, we're trying to isolate micro auctions inside of the auctions, and a tool like Window Trader allows me to isolate those. So you can do both. You can do it here. You just have to see the nuance a little bit more. Yeah, totally. Any other questions? Great question. Going once. Going twice. We only got about 9 more minutes anyway. Yeah, go ahead. Or yeah, asked if you could ask another if you could. Absolutely. I mean, I'm here so people can ask questions, and I want to be helpful. So that's the whole MO to do this. Because guys, trading's hard. I mean, it's simple, but it's a hard business. And many people come in and they go through all these different stages. And like the first stage is kind of this, I don't know what I don't know, and you have a really awesome thing happen, or you have an opportunity. I remember like my first trading experience was in 08 and 09 in the crash, and I had a friend that recommended that I buy a regional bank stock. I think I paid $250 a share, and I bought 100 shares, and a month later they were at $5 a share, and I went, huh, like, dude, I got to be able to do this more often. Little did I know how much I didn't know. And so, stuff worked for a while, and then it didn't work, and then, you find out what you don't know, and then it works for a little while, and then stuff doesn't work, and then, eventually you get to a place where you can have a system that you can rely on day in and day out, and that's really great. And then especially when you get to a place where you don't even have to think about it. Like, it's instinctive and habitual, and then you start to feel the flow. It's almost like, if you've seen The Matrix, where you're just watching The Matrix and you're just like, I know what this means. But at first it can be tough. So, man, if knowing what my journey was like, if I can help somebody else get through that quicker, that's pretty awesome. Okay, maybe another example of trade idea using point of control. Sure. Yeah. Okay. So, like, here's how I think the question is around how to identify and use kind of all of these different profiles, these peaks and valleys to figure out trade ideas and positions. So let's look at NASDAQ, for example. Okay. So here we have the fairest price, which is this. Zoom in here. So this is this green bar right here. That's the highest contract, and then you can see kind of this faint line up here and down here that is the value area that's 70% normal distribution of trade. So think of that like a magnet. All right. So that's a fairest price. So tomorrow, the most relevant price to the market is this fairest price and this value area, because that's where all the business went. That's the market's closest memory is that. So tomorrow when we open for the real-time session, however close or far away we are from that tells us something. It tells us whether or not who might be in control. So if we gap down hard tomorrow, or we gap up hard tomorrow, I mean, nobody knows. I have no idea. If we're far away from today's value, then it tells me that some other time frame player is involved. And what I mean by another time frame player is that one of the things that happens in markets is you have people who are operating in all kinds of different time frames. You have the guy who's the day trader, and then you have the guy who's like the Warren Buffett. He doesn't. A day trader cares what yesterday's open price was. Warren Buffett does not. Bill Ackman does not. I mean, Carl Icahn, they don't care. Because they have unlimited resources, seemingly, to be able to position where they want. And so they don't care what an open price is. So if I see a move that doesn't care what the open price is or the value area of yesterday, then that tells me that some other time frame is in play, and I got to look at levels that are relevant to a bigger time frame. So if we open close to this range tomorrow, then the levels that I'm looking at to lean against are going to be these. So let's say, for example, say we open at 45.75. Okay, we're actually just 2 or 3 points below the prior day's range. That's not far away. So what that means is, even though there's a little bit of a lean to the downside, it's not much. So what's most powerful in terms of pulling that trade is going to be these levels from yesterday. So you could actually have a high probability trade buying right here at 76, because this was an area of acceptance, and it being responsive back to, because if you think of an auction, we're going to test in a direction, and then we come back to a known price. So it's likely to come back to this known area. Well, if you plot 76 back to 84, which is the value area, that's almost 10 points. So that's almost $200 a contract. If we come back to the point of control, it is 10 points. So that's $200 a contract. That is a way that you can identify some trade ideas. You also can look at this and say, if we move away from this accepted price, then we're going to go explore, and then I've got a place that I can define some risk. So say we do open tomorrow at 76, and we trade back up here and to this value area in the point of control, and we can't get above that, then I could actually get short up here, I'm wrong up here, so I could, define my risk to be really tight, and then I'm targeting prices much lower, and I'm actually targeting this zone or this composite price down here at 68. So, in terms of the peaks and valleys, I'm leaning on them based on what type of day it is and who might be in control. If it's a big time trader, we have a big massive move, then these little bitty levels don't mean much at all. And that's when I start looking at a larger long-term chart where like I could actually look at, say for example, we looked at, this is this massive move we've had most recently. I can look at this thing and draw a profile across it and say, okay, so there's actually 68's a level, but if we get below 68, look where our next big level is. It's all the way down at 44.44. So that's, like if we have a big move, those are more the levels that you look at rather than the day-to-day levels. So I hope that answers that. You look at those multiple time frames. You go to a bigger time frame if there's a bigger move, because that's more likely a larger player in control. If we're tighter and closer to the prior day's range, then we're looking at some of those smaller time frame charts. So like if you were in toss, for example, if tomorrow, if we're open inside this range in corn, I'm looking at levels of the value area yesterday and maybe levels, real close to that. In fact, one of the cool things of auction theory, and this is demonstrated over 5 years of trading data, which 1,400 sessions or 5 years of trading data is a good statistical sample to see, because as markets change and determine. But if you have an open and you print in the first hour in both of those 30-minute sessions inside the prior day's range, and say, for example, the prior day was a balancing day, which we had that today in the NASDAQ. This is what we call a balancing day, see how nice and round, nicely shaped this bell curve is of the trade. So if we spend 2 30-minute sessions inside this, you actually can project the expected range of the day, give or take 5%. What kind of crazy edge is that? I can basically look at it and go, oh, well, today's range was 83 ticks. So if we spend, 2 30-minute sessions inside of, today's range tomorrow, then I can try to pick where I think the top or bottom is and add 83 ticks to it, and that's pretty much the range for the day, which is, fascinating. Because then I know, okay, I could lean against the level, I could, have an expectation of where we move and where we don't move and all that. So, okay, awesome, great. Yes, Alan, you came in late, but yes, we'll be sending a recording to everybody that registered. So we got that. All right, I'm going to give like 30 seconds for anybody who wants one more question, and then I got to get a kid to a basketball game and get on with my evening. But thanks for everybody's questions and time. I hope this was helpful. If after reviewing it you have other questions, man, shoot me an email. Again, I'm just trying to help you as best we can. If you do want to look at futures, we do have a Slack channel, so it's totally free. But if you want to go to our website, Market Profile Trading Academy, and go to contact us, in the sidebar it actually shows a place where you can click and get a Slack request, and just get inside our Slack channel and just talk to us, man. Try to make this simple. Very, very simple. That's a great place that we could continue the conversation. Again, it's totally free, and I'm a trader first, so that I'm focusing on my trading, but it's got cool notifications in it, so if somebody asks a question, I can get to it, and I know what I've answered, what I haven't answered, stuff like that. And there's some awesome traders inside that room too, that are all looking at futures and all looking at this market profile tool. So to have a focused place like that is pretty awesome. Yeah, in terms of other videos or webinars or books, actually, check out our website. We've actually got a bunch of just a load of webinars on our blog. webinars, examples. I'll pull this over here. But if you go down here, I mean, you can just click on all the stuff. We've got 33 videos. We've got like weekly trade plans. We've got stuff on trade management, tips for newbies, trade execution. All the stuff is totally free. Please go use it. And if you have questions off of it, shoot us a line. In terms of books, Jason, I would recommend all of Jim Dalton's stuff. Mind Over Markets and what's the other? Markets in Profile. That's the other book of the two of Jim's. We love his stuff. Window Trader, Terry Lieberman, who put Window Trader together, he put that together with Jim, and so I mean, this is a tool that actually leverages a lot of that. Auction's built to be able to see all the components of auction all at one time. So that's a book that I'd highly recommend. Of course, like Jack Swagger's series on Market Wizards is great. It's a classic too. But yeah, you guys have any questions? Give us a shout. Drop us a line. We'll send this out. If you watch it back and you got more questions, man, just seriously drop us an email. Love to help you out. Okay, that's it for today. Thanks everybody. We'll catch you next time. If you have an idea for a specific webinar that you'd love for us to do this, again, we try to do this like every other Thursday. One that's a decent rhythm for me. I could commit to doing it every other Thursday, and we can spend an hour and work on whatever we want to do. If that helps you and that can help you move forward in your development as a trader, then we all win. Because kind of my other MO in this is I think markets need more competent traders. Just give you some stats and then I'll get off here. So it is true 90% of traders lose money. There are a million brokerage accounts that are opened every year, and the average run rate for a brokerage account is 3 months. 3 months. And then those accounts are closed or done. That's not encouraging stats. So this, even though trading is simple and it's easy to say, oh yeah, well if I buy this and do that, then but it's a hard business. And if you're going to be successful, it's the equivalent of being like a professional sports athlete. Or professional poker player or whatever it is of level of proficiency. It's going to take a lot of work, and you're going to need resilience, and you got to love the game. If you don't love the game, you won't last long enough to get to a place where you can be proficient and you can navigate in this thing. It's just going to beat you up and then beat you up and crush your dreams. And we don't want that to happen. I've had enough pain in my own life, learning this deal. And now on the other side, man, if we can help shorten that for everybody and get them past the pain quickly, I'm not saying we can alleviate the pain. You actually have to have that. It's part of becoming great. But man, if we can concentrate that and get you past it, get you through the crucible, it's worth it. Because the whole market, and even people who don't participate in markets directly, will benefit from having more competent traders in markets. Pure and simple. So it's got a much larger frame of focus than even just what we're doing for ourselves. But it's what can we do for people that are invested in 401ks and IRAs and stuff like that, who aren't going to be actively participating in markets. If we can bring good, solid markets because the player's in it, then everybody wins. And that's great. All right, that's great. Have a great Thursday night, guys. We'll get this out to you as soon as possible. And love any feedback that you could offer. Really appreciate the time. It's very validating as a trader to know that we're helping. So have a great night. We'll talk to you soon.